Hi, it's Jeffrey Cohen, Chicago Quantum. It's Tuesday, December 20th, and we're going to talk today about companies that made huge profits. And the list is actually going to surprise you. And we're going to keep up our COIFIN sheet here because I think it's going to be helpful. And we're going to get right into it. And so, this is a list of companies that are sorted by the Chicago Quantum Net Score. So when you look at these, the ones at the top are actually the ones that if you can only hold one stock, they have the best risk-return trade-off. So the fact that you're watching, let's give away the store a little. The best stock in the United States right now, if you can only hold one, is NVIDIA. Then you have Mercado Libre and Synaptics and Advanced Micro Devices. So why do you have these stocks? Why are these stocks good? And by the way, QQQ is number 17. So in fact, and then number 23 is the S&P 500. Actually, that's number 24 because it starts at 0. So number 18, QQQ. Number 24, SPY. And so the question is, why? First off, why is that? And then look at the Russell, number 34. The SHI, number 35, and that's the 1 to 3 year Treasury bond ETF. Let's see if we can find that long bond. Nope, physical gold, 65. So the markets look like they want you to take some risk. I love it. This is when we make money. In fact, I looked at the run that we did today, and as of before we made this video, the Chicago Quantum Net Score up run hedged by the S&P 500, it looked like it made a lot of money today. And so it's like we're back, right? We're doing great. And so let's talk about it. So if you assume the markets are going to go up over the next year, then it's a risk-on situation. Risk-on. So it's risky, right? And then there's risk off. So what this motto is saying is hold fewer stocks. Hold fewer stocks. Which means have smaller overall positions. Our model right now says to hold 7 stocks. So that's not a lot, right? That could be for a $50,000 notional account. That could mean you have $10,000 or $15,000 invested on the 50. Now you could double up. You could say, "Hey Jeff, I want more leverage. I want you to go, with the full 40," and that would mean a very heavy risk concentration. Where if the model does what it's intended to do, and the market is going to do better, you're going to make money. Now what's interesting is today's a day when the model's making money, and yet the S&P 500 is at 0% rise. So what this tells you is the market is actually pulling alpha out of the market, even though the overall market is flat. The stocks that our model likes are doing very, very well when they're held together. The key is, if you could just hold one stock, you buy NVIDIA. Wrap it up. It's got a 22% expected return. Right? Last day volume, 65% of last year's volume. It's at 85% of last year's price. It's down 15%. Variance is high. You can go Mercado Libre with a much lower variance. Does not pay a dividend at least up to 1%. And it's actually quite a high market cap. But if you like Mercado Libre, you got a higher expected return. You got more volume traded. It hasn't fallen as much in price. It's half the variance. So you can start to look at these stocks and think, look, if I'm going to take a flyer and I'm going to bet on something going up, I got it. Now, Mercado Libre is a lot less risky, right? You could go Synaptics, which is double the variance of NVIDIA, or quadruple the variance of Mercado Libre, or you say, you know what? I'm good. I'm going to put some money in like monolithic power systems, right? That's got a lot less volatility, but still a 21% expected return. Still scores better than holding all the stocks, or like the S&P 500 or the QQQ. So you got some choices here. The market looks good, and the reason the market looks good is because we're calling for an 11% return on capital invested in the stock market over the next year. Now, it may not happen right away, right? So the early in the year it might go down, but later in the year it may go up. That's kind of what the pundits say. But we see that with a flattening or a peaking of risk, a plateauing of risk, there's a chance. There's a chance here that the market could go up. And we think 11% is fairly reasonable. So let's go into it. So here's the stocks. Let's look at the net income. We're going to sort net income for companies that have a positive net income. Apple made $99 billion. I want you to think about that the next time you shell out $1,400 for an Apple phone and you buy some apps. You know, it's fine. Now, here's the funny part. You can buy a Microsoft phone or a Microsoft tablet, right? And they earned $70 billion. Alphabet, you know what, Jeff? I like Android, he says. I like the Pixel drive or the Pixel. Well, they earned $67 billion. All of them earn. So I'm really surprised that they are the top three earners. Tech. No wonder why the stocks trade for a lot of money. Then you have ExxonMobil with a respectable 53.6 or 54 billion. And then you have JP Morgan Chase with 37 billion, Chevron, Pfizer, you know, the big drug company. And then you have Meta. Now Meta is Facebook. So Facebook is generating 29 billion. Then you have Bank of America, so two banks, AT&T, you have a phone company, and Verizon at 20 billion. You have United Healthcare. So you see your first healthcare company. United Healthcare, the big insurer. Very advanced. Then you have another drug company, Johnson & Johnson. So now you've got Pfizer, Johnson & Johnson, ConocoPhillips, another oil and gas company at 18 billion. Wells Fargo, third bank, almost 18 billion. Now you got Home Depot, your first retailer. Now you got Citigroup, four banks. This one earned $16 billion. Then Merck, another drug company. Visa, now you got a financial services firm that's not a bank holding company. And now you're getting into some consumer products, Procter & Gamble at almost $15 billion. Goldman Sachs at $14 billion. By the way, I heard Goldman Sachs is doing a huge layoff. Thousands of employees to save money. And, I can understand it, right? A shoddy showing here at $13.87 billion profit. It's just not enough. It's just not enough, right? So it's crap. I get it. Let's fire all the secretaries. You know, let's the junior bankers, get them out. Analysts, IT people, throw them out. We got to make more. I love it. I want to make more. I get it. So we'll take a look. Then you got another Marathon Petroleum Corp at $13.5 billion. Another oil and gas. You got another drug company, AppV. They're the ones on the drug discovery side, as opposed to on the commoditized, production side. And then you got two chip companies, Intel and Qualcomm at $13.3 and $12.9 billion. So we're going to stop here at, another oil and gas company, Occidental Petroleum, Morgan Stanley. I guess we could stop here. I was going to stop at 10, but there's a lot of companies. There we go. Maybe I'll just talk a little bit. We'll stop at 10. So you got AIG, which is an insurer that went belly up in the great financial crisis. They finally shut down that department that took them under. So Phillips 66, oil and gas, United Parcel Service, so logistics. It's interesting. Tesla. So people talk about Tesla as if it's a company that's just all hat and no cowboy. But I got to tell you, Elon Musk, he's a cowboy. Earned $11 $1.2 billion in the past year. More than UPS. More than Coca-Cola. More than MasterCard. So, come on. Quit farting around, right? Broadcom, a tech company. Cisco, a B2B tech company. Amazon, the retailer. Moderna, which is always interesting. So Moderna is a biotech company. So these are the companies that earn $10 billion or more. Now, I wanted to do a little bit of math with you. So we know the industries they're in. Largely speaking, it's banking, oil and gas, tech, pharma, telephony, one retailer. Actually, two retailers. A consumer products company, two investment banks, two tech companies. Actually, physical tech, that's not really true. So 5 or 6 tech companies. So we're going to look at total income. So we're going to add back AOCI. So AOCI is the income that you don't count. Well, I don't understand, Jeff. Why don't you count it? Because the government says you don't have to count it. So if you're holding a bond and the bond goes down in price or goes up in price, you don't have to count it till you sell it. Okay, cool. Because I'm holding it forever. I just plan on doing that. Currency valuation. Sometimes if you hold currency and the currency moves against you, you don't have to declare. What I notice is the top companies that make a big profit, all of their AOCI or accumulated other comprehensive income is negative. Now, like Qualcomm, it's like 22 million. It's nothing, right? Occidental Pete, 87 million. It's nothing. Broadcom, 54. But others, 5.7 billion from Morgan Stanley. Procter & Gamble lost $12.8 billion. Oh my God, Citigroup lost $48 billion. This is what I'm talking about. It's triple. It's triple what they actually earned. But I'm sure if you were to read the press release, they'd be like, oh yeah, we earned $16 billion. We are doing great. Don't look behind the counter though with the AOCI, because we lost a lot. Triple. We lost triple. So we're going to add those up. I'm just so curious to see what happens, right? I'm fascinated. I'm sure it's no big deal. But let's take a look, because this is how you build a better understanding of the true earnings power of the firms that you are talking about. So we made it all the way to AIG. That was the 10 billion mark. And so now we look, and AIG lost money. In fact, I'm going to do a conditional highlighting here, add a rule that if it's less than 0, I want a red fill. Okay. So now we see that AIG lost money. Citigroup lost money. All right, 2. No big deal. Hey, it's not me, it's you, right? Or it's not you, it's me. So how clean is the income? Let's look at net income actually, let's look at cash over net income. And the reason I say that is I'd like to know that they generated cash of about the same amount of net income. If these numbers are like 100% or more, wow, is this a very healthy company? Because it means they didn't just take accounting gains, but they actually made the money. So it should be cash over net income. So cash flow from operations divided by net income. Give me this as a percentage, right? I don't need all those details. So 122%. So Apple's earnings are beautiful. They earn 22% more cash than accounting profits. If anything, they're probably managing their earnings so that they don't get a lot of taxes. That's great. You can see Broadcom, Tesla, 43% more cash than earnings. Amazon, 300% more cash than earnings. Now you see where the money's at, right? Now we look, Morgan Stanley, 63. AIG, 43. Not so healthy. Qualcomm at 70%. Now here, you see Citigroup again. So we're going to do the same thing, and we're going to highlight, add a rule, less than 0, red fill. Now we see that Citigroup has another red flag on them. And Bank of America, pretty shoddy at 27%. But there, JP Morgan Chase, very healthy. They make $2.50 of cash for every dollar of earnings. Love it. All right, what's the debt plus equity? So this one's a little more esoteric because it says to value a company, you have to look at both let me make sure I'm doing this right. So if you want to assess the valuation of a company, you add how much they owe because they have to pay it back. That's like a bondholder. So you add stocks plus bonds. Think of it that way. Stocks plus bonds is the total value of the company. So I take debt plus market cap, which is stock, number of shares outstanding times the stock price. And I look and you see that Apple's worth $2.26 trillion. It's a lot of money. But let's go down the list here, right? So these are companies that earn $10 billion or more. I don't understand why that happened. Let's take a look. Come on, go back. There we go. So we see the valuations. We got 80 billion, 81 billion, 65 billion, 521 billion, 922 billion. There are 3 companies worth more than $1 trillion. Alphabet, Microsoft, Apple. The 3 companies that earn the most and have the cleanest income. Okay. They have clean income. They have very high valuations. You see the 4th company, ExxonMobil. For the company that earned the 4th, the 6th, the 7th, the 8th, the 10th, look at those valuations. The 12th, 288, the 16th, 15th, 156 billion, but yet they earn 12 billion. So ConocoPhillips appears to be a steal if they can keep earning. Other companies that look like they're going to earn more on a more consistent basis, United Healthcare, Bank of America, maybe they're not so sensitive to economic conditions. JP Morgan Chase, valuations are higher. And so now we're going to look at market capitalization and we're going to do our first valuation, our first good way to compare them, right? Because we're going to take the market cap. Actually, I want to do this the right way. How would I assess the value? We could look at the market capitalization of the stock, which is debt plus equity, and we can divide it by some earnings power. It could be income after AOCI. It could be cash. We have to come up with some way, some multiple, right? And so let's think about what that multiple should be. I think it should be total income, which is net income plus AOCI. And it should be total market cap. So it should be total market cap divided by total earnings. That makes sense to me. So we're going to take a look at this, and we're going to see how we would compare them. So the total market cap is the total corporate valuation divided by the total earnings. Now, this is a very static view because who knows if this is going to last, right? You don't know. Now, you can see that Apple trades at 25.5 multiple. How do the others trade? 25.5. So you're paying 25 times earnings for Apple even after the market has corrected. Now you look and you see others. You see highs and lows. We're going to take a look. We're going to try to figure out what the right highs and the right lows should be. So we're going to add a rule. We're going to say if it's greater than 20, it's high. It's a big green. If it's less than 15, it's red. 15, 14. Now we're going to stretch these out a little bit. It's too much. Let's go greater than 22. Less than 14. See if we can create some space there. All right, done. So what you see is that Apple and Microsoft are very highly valued. Actually, Alphabet doesn't make that cut. ExxonMobil looks cheap. Chevron, Meta, AT&T looks cheap. ConocoPhillips looks cheap. Citigroup looks dirt cheap, like Credit Suisse First Boston. Marathon Petroleum looks cheap. Occidental Petroleum looks cheap. Moderna, Qualcomm, Intel. Now, what looks expensive is Procter & Gamble, Wells Fargo, Johnson & Johnson. So, does the story have a happy ending is going to be the question. So now let's just take our multiples and go all the way down. Because I'm actually quite curious to see what the universal settings are. So those are total income. And honestly, I don't like to see negative income. So I don't think that's okay. I think negative income is bad. Companies should be able to produce profits. They really should. If they're not producing profits, they really shouldn't be in business. Right? I mean, my company right now is not making a profit. Every day I think about whether I should be in this business or not. It's stupid to be in business if you don't make a profit, right? I don't believe the idea that you lose on every sale, but you make it up on volume. You lose on every sale, you lose on every sale. I don't care how many sales you make. You're still going to lose. Make money on every sale. As you grow, you make even more money. It feels great. So what are we looking at here? We're looking at how clean is the income. Cash over income. The max is 132 times. The minimum is that they lost cash, right? Let's take a look. Let's sort. So first off, I want to save. Thank you. Let's sort this up. Let's go descending order. Who generates the most cash? Box.com, Cars.com, American Axle, Iridium Communications. Those are the satellite people. They probably got great write-offs. eBay. eBay prints cash, baby. Look at that. 66 times. Hyatt Hotel. Wait a minute, that's Pritzker. J.B. Pritzker's company makes a lot of cash, not so much earnings. Oh, I guess that minimizes their taxes. That's terrific. Worth $10 billion. Net income is $9 million. By the way, $9 million. Okay, just pause for a minute. Here is a governor who talks about, we all got to pay our fair share, but yet his company has minimized net income to $9 million. I can't even imagine the artwork that went into that process. It's a thing of beauty, I got to tell you. It's a thing of beauty. It's a thing of beauty. Wow. All right. Where else are we? Come on. Jeffrey. Who's got cash? Alaska Airline. Oh, Prudential Financial. All right, so there's some good companies in here that look solid. Alcoa. I'm sure they write off their investments to the aluminum smelting plants, but they're making good cash. Look at that. ServiceNow. 12 times cash to earnings. So that's great. So I see it. It makes sense to me. I got this. So now let's look at market cap multiple. Let's sort that one descending. Rockwell Automation. Rockwell Automation is worth 20,000 times its earnings. It's because they only earn $1.6 million. RadNet, Cars.com. So the high multiples are for companies that have their earnings to be so tiny. ServiceNow makes $28 million. How can that be? ServiceNow is a multi-billion-dollar behemoth. So Wintrust Financial, our local bank. Our local bank loses money after AOCI. No, earns $5 million. Do you have any idea? It's a huge bank. It's a huge local regional bank and earns $5 million. T-Mobile, U.S., 900 times earnings. General Motors, 838 times earnings. And you see the point. It feels weird. Aerojet Rocketdyne Holdings is being acquired right now by L3Harris. They just announced an acquisition. The company's worth $4.8 billion. L3Harris, you're buying $10.6 million of earnings. I would think that L3Harris' stock would go down. How is that going to be accretive? If you don't understand what that means, DM me and I'm happy to explain some of this. Raytheon, 356 times earnings. So these are companies that have very, very high capitalization, very, very high debt plus equity relative to the profit that they throw off. ADP, 346 times. McCormick, they're the spice makers, 252 times earnings. Oh my God, I'm going to throw up a little bit. Just a little. Just all over the floor, actually. Procter & Gamble's at 207 times earnings. DXC Technology is at 200 times earnings. That's a B2B. That's weird. It's worth $6 billion. Their net income was 772, but their AOCI was 724. They only earned $48 million. So, of course, I'm puzzled. I'm looking at these companies, and these are the most expensive companies in America. Now, I don't see the ones that have the most profit being this expensive, because let's be honest, no one can really afford that except maybe J&J. J&J is interesting. J&J has a total corporate valuation of $500 billion. That's not bad. That's not shabby. Total income, call it $4 billion. So they're at 128 times earnings. Still seems pretty high. What happened? It's like, Wingstop I can understand. I love wings, right? 125 times earnings. Hasbro, Mattel at 125 times earnings. Because think of a tuck-in acquisition. If you're a Walmart, why not buy the number 1 and number 2 toy companies? It costs you nothing. You buy both of them for $20 billion. You're Walmart. You now own the toy industry. Forget about it. And by the way, what a great idea. I should pitch this to Walmart. You can buy Hasbro and Mattel for $20 billion. By the way, it doesn't actually cost you $20 billion. Do you know why? because the equity is 5 billion, and the rest is debt, and you could just roll that debt. Cost you 5 billion. You own the toy industry. God, I wish I was in private equity. So much money to be made here. So you just take a look at this and you think, all right, I got this. There's a bunch of crap down here. This part of the list I don't really like. There was one stock, though, I recognize that I like. Newmont Mining. How's Newmont Mining doing? So Newmont Mining will cost you a cool 131 times earnings. Are you fucking with me? Are you kidding me? Newmont Mining, gold mining. Oh, I got a gold mine here. It's worth $42 billion. Debt plus equity. Look at the cash, though. It's 10 times cash over income. Total income, $318 million. It'll set you back 21, 22 billion to buy it. Generates $3.5 billion in cash. God, I love cash. $3.5 billion in cash. Cost you $42 billion in total. 42 divided by 3.5 is about 12. It's 12 times. It's 12 times cash. But it's 131 times income. So the question is, what do you believe? Do you believe the cash? Do you believe the income? So that spread is so important there. So, all right. So I showed you what I was going to show you. Let's do a quick save. Let's come back. Because if you're like me, you want this to make sense, right? You want it to make sense. You want it to be clean. So the idea that you would have a negative multiple of market cap to total earnings also doesn't make sense, because you're buying losses. You're buying losses, right? And so maybe you don't believe those losses will occur forever, but Philip Morris has lost $9.3 billion after their AOCI, and their common equity is minus $9 billion. So Philip Morris is no joke. The only reason you buy it is for the dividend. But if you go somewhere where it's positive, look at all those negatives. Those are all companies that destroy value by being in existence. Maybe not a lot, but a little. So where's a company that's trading? Here it is. 0.1. So you buy the whole company. Oh, I see why this is. Nope. So I've got to take all those AOCIs and I got to zero them out. Because there is I got this. Hang on. I have it black because we have a default in our system that if you're all nines, it's the error code. So I know that errors are nines, right? So anything with all nines should actually be zero. It's just a way to know that our data provider has given us no data. So that's okay. We don't mind. Let's just clean that up. Because that could affect the multiples a little bit, especially on the smaller companies. I could make it just 9, actually, and then no one would care, because $9 does not affect any of the valuations. I'm going to write that down. Look at all those AOCIs that are not reported. So these are companies either with no AOCI or it's just not reported. That's fine. There's a lot of them, actually. A lot of them. All right, we'll clean that up. Oh, it's crazy. So, same thing. Common equity. for the 9s. Look for the black bar. None of them. So none of them failed to report common equity. Well, actually, there were a few that we cleaned up, but it wasn't much. There we go. There's a lot of these. Copy. I know it's just faster to do it this way. Paste. It's so fascinating, right? You realize, oh. The reality is it's going to be very rare for anyone to have $9 of earnings or $9 of assets. So we're going to do that. We're going to clean that up. So interesting. So we do this in Python. We generate the spreadsheet, and then it's there every day. It takes a lot of work. This is a very manual process. I know it is, but I love it. Okay, we'll look at cash flow from operations. Not a lot of 9s there because it's, again, companies will report their cash flow from operations. So these are ETFs. So what I'm going to do here is I'm actually going to delete all those ETFs. They don't need to be there. Good. Clean that up. So anything with an exclamation point is just not clean, and that's fine. So let's go do the same thing we had before. Market cap multiple. You still have a stock at 20,000 times. Thousands of times. Hundreds of times. Right? So you look at this, and you in Newmont Mining, right, at 131 times. You still look at this and think, okay, there's stocks that are quite valued here. We look at how clean is the income. We saw that one already. So I guess what I'd like to do is see, are there companies that just by random chance are trading almost for free? 1 times earnings. Chimerix. Chimerix has a valuation of $163 million and earnings of $153 million. Intrepid Potash, Acacia Research, Eastman Kodak. You're buying it for 1.6 times earnings. Alpha Metallurgical Resources, they make coal, metallurgical coal, which is used in steel production. Alpha and Omega Semiconductors, right? You're buying that at like 2 times earnings. So you look at it, the companies don't, these are not household names. Matson, Azenta, Omeris, Sinclair Broadcast, PBF Energy. U.S. Steel is interesting. U.S. Steel trades for 3 times earnings. And when you look at this and you realize that the cash is clean, $4.2 billion in cash, $3.8 billion in $3.4 billion in net income, they're generating 24% more cash. Their AOCI is positive, so they don't have any garbage. They're worth $10.4 billion on the balance sheet. Corporate valuation 9.6, so they're trading at roughly 1 times valuation. There is a steal. So USX is a steal. No pun intended. So you got to look through Arch Resources, a coal company, trading at 2.8 times earnings. And so you looks clean, 107 times cash versus net income. Smith & Wesson Brands generates $137 million in value in a year, worth $387 million. It's 3 times earnings. They generate way more cash than income. Smith & Wesson. So I've got U.S. Steel and I got Smith & Wesson. I'm making a note for myself. Maybe these are stocks I might want to look into buying. Laredo Petroleum, LPI. You know, I made money on Laredo Petroleum about a year and a half ago when oil was down. This one made me a lot of money, actually. So, not to say I haven't lost it all, but still. Clean companies, SciPlay, but a lot of them, again, I never heard of. Intercept Pharma, California Resources Corp, Peabody Energy. Now, this is interesting. 3 times earnings. Common equity at $2.6 billion, total valuation $4.4 billion. So this is really your play on coal right there. Coal was cheap. Boise Cascade, 3.6 times earnings. So a lot of companies right here in the sweet spot. PDC Energy, I made money on that one. So I just love this because now you got all these companies right in the middle of the valuation, right? You take the debt and the equity, you take how much actual profit they generate after taking into account off balance sheet kind of losses. You put it all together, you make it a complete picture, and you're at 2-3 times earnings. By the way, I love it. Let the market fall another 500-600 points. These are all going to get cheaper. Let the market say that we're going into a recession, that we have a recession risk. They're all going to get a little cheaper. And I could see myself, or smart investors like yourselves, pick up a few. So let's go back to what I originally talked about. So I'm very excited about this because this gives me a whole different way to look at stocks. This says there's a way to use the data to make money. By the way, you can have the spreadsheet. How, Jeffrey? I produce it every day. Every day. $100. $100. I give you the picks, the stock picks, the portfolio picks, picked by our model. I give you all the different metrics. Jeff, are there any skewed stocks? How's the kurtosis? Maybe your fourth order movements aren't normal. Well, my movements aren't always normal, but that's a personal issue. That's why I eat a lot of fiber. But stocks that don't have normal distributions, sometimes there's some power in that data, right? We look at the Chicago Quantum Net Score. We pick portfolios that are true winners, that generate alpha versus the S&P 500 beta weighted. At least that's the intent. That's the objective. And has proven to be true in many, many cases. $100. Normally $750, but we've discounted it to $100 because we want to get people in. You can have all this data. Now you got to do the couple extra spreadsheet things I did. Just watch the video. You do your own calculations. And by the way, you can call me if you're a client. Hey, Jeff, I'd sure love another one of those columns. I've actually pulled columns out because it actually creates a lot of memory draw on the server. And if there's too many columns, it elongates the run. But, one more column, why not? One more test, why not? Maybe, Jeff, you could add up the columns for me and do all the multiples for me so I don't have to do it myself. Takes up some more system memory, but yeah, we could do that. It's great. God, I love this. So here's where we're at. $100. Get you the spreadsheet, get you the run, the full report, all the data. It's awesome. So I want to thank you guys for watching because I learned a ton just doing this. I learned that Smith & Wesson, Laredo Petroleum, U.S. Steel, these could be true bargains. They also could be dogs, but true bargains. You have a lot of stocks here that could be true bargains. The other thing that you have is you have the most valuable companies in America. And this list truly surprises me. Apple is worth $2.26 trillion. Microsoft, $1.85. Alphabet 1.15. Amazon $922 billion debt plus equity. Add in some more tech companies. Tesla. NVIDIA. Now you're Meta. Now you're down the line. But you can look and say, okay, tech is worth a lot. Banks, JP Morgan Chase, Bank of America, Citigroup, that's worth a lot of money too. And then you say, okay, how's the income on these guys? So what companies make the most income? And the list is fairly consistent, which says income drives valuation, which is good. It's logical, right? So Apple, Microsoft, Alphabet, ExxonMobil, Chevron, AT&T, Verizon, Pfizer, Meta. These are the companies that are generating a lot of profit. Tech companies, right? Qualcomm. I guess you can call Verizon and AT&T tech companies, just behind Alphabet, Microsoft, and Apple, right? And now you look at Broadcom and Qualcomm. Now you look at the financial services companies. You see J.P. Morgan, Goldman Sachs. All right, I got that. And you look at oil and gas. You see ExxonMobil, Chevron, Marathon, Occidental Pete, ConocoPhillips, Phillips 66. So it's a lot. It's a lot. They're generating a lot of profit. And so as long as the economy's okay, these companies are generating massive amounts of profit. I don't think people realize that Apple generates $88.7 billion of profit in a year. And so I want to thank you for watching. I'm surprised. You're probably surprised. And so I hope you have a great day, a great end of the year. I hope you have a happy holiday. Be safe with your family. If you're traveling, I hope the weather doesn't hurt you. And stay tuned. We're still here, and we are discounting the heck out of our one-time run services so that everyone can at least see what we see. Now, if you want us to run money for you, that's a different question. You got to go to our website. You have to ask, may I please see it? Because by law, we can't show it to everyone. If you can prove that you're kind of the capability to have us invest your money because you can handle the risk, definitely glad to talk to you. So thank you very much. You guys take care now. Bye-bye.